Every single year, American consumers pay approximately $130 billion in credit card interest. $130 billion. That number is so large, it is almost impossible to make meaningful by just saying it. So let me make it personal instead. The average American household carrying credit card debt pays approximately $1,300 per year in credit card interest. Not on principal, not reducing their balance, just interest. Just the cost of having borrowed money from a credit card company and not paid it back in full before the interest began accruing. $1,300 per year. That is a car payment. That is several months of groceries. That is a vacation. That is a significant contribution to a retirement account. That is money that a significant portion of the American public is simply handing to credit card companies every single year for the privilege of carrying a balance. And the most remarkable thing about it, the thing that makes this number both infuriating and fixable, is that virtually every dollar of that interest is completely optional, not unavoidable, not the cost of using a credit card. Optional, elective, the result of not understanding a specific set of mechanics well enough to stay on the right side of them. The people who use credit cards without ever paying interest are not people with dramatically higher incomes, dramatically more financial discipline, or access to some secret product that most people cannot get. They are people who understand exactly how the interest calculation works, who have built a specific payment system that keeps them permanently on the correct side of the grace period, and who have made that system automatic enough that it runs without requiring ongoing willpower or conscious management. What they know and do, you are about to know and do. Welcome to Klux One Finance. Let us get into it. To never pay credit card interest, you first need to understand exactly how credit card interest works at the mechanical level, because the way most people think about it is subtly wrong in ways that cost them real money. Most people understand that if you do not pay your credit card bill, you pay interest. True, but the specific mechanics of how that interest is calculated, when it starts, and what resets it are not as widely understood, and those details are where the money actually lives. Credit card interest is expressed as an annual percentage rate, the APR, but it is not charged annually. It is charged daily. Every day you carry a balance. The credit card company calculates a daily periodic rate, your APR, divided by 365, and applies it to your average daily balance for the billing cycle. A card with a 24% APR has a daily periodic rate of approximately 0.066%. On a $2,000 balance, that is $1.32 of interest accruing every single day. $40 per month. $480 per year. From a single $2,000 balance at an interest rate that is not even at the extreme high end of the current market. The interest accrues from the moment you carry a balance into a new billing cycle, meaning from the moment you do not pay your previous statement balance in full by the due date. This is the grace period, and understanding it precisely is the foundation of the entire no-interest strategy. The grace period is the window between your statement closing date and your payment due date, during which no interest accrues on purchases made during the previous billing cycle. If you pay your statement balance in full before the due date, you pay zero interest. The credit card company essentially extended you a short-term interest-free loan for the length of the billing cycle, plus the grace period, typically a total of somewhere between 21 and 51 days from the date of purchase, depending on when in the billing cycle the purchase was made. This is not a secret. It is in every cardholder agreement, but the implications of it are not well understood. The grace period means that credit cards are, for people who pay in full every month, functionally interest-free financial products. You make purchases. You have 21 to 51 days before any interest would accrue. You pay the full balance. Interest never accrues. You have used the credit card company's money for free for up to 7 weeks and gotten rewards for doing it. The grace period disappears the moment you carry a balance. This is the critical detail that most people do not fully appreciate. If you pay only the minimum or pay less than your full statement balance, On your payment due date, two things happen simultaneously. First, interest begins accruing on the remaining balance immediately. Second, and this is the part that surprises people, interest also begins accruing on new purchases from the moment they are made, not from the statement closing date, not from the due date, from the transaction date. This is called the loss of grace period. And it means that when you carry a balance, every new purchase you make starts accruing interest immediately rather than getting the free float that new purchases normally receive. In practical terms, this means that the moment you miss paying your statement balance in full, the effective cost of using your credit card increases significantly for every subsequent purchase you make, even if those purchases would have been interest-free if you had maintained a zero balance. The credit card company is not being deceptive about this. It is in the cardholder agreement. But the compounding effect of carrying a balance on the interest cost of future purchases is something that most cardholders have never had explained to them in clear language. And understanding it is a powerful motivator for maintaining the full payment habit. So what is the payment system that eliminates interest forever? It is simpler than most people expect, and it has three components that work together to make paying interest essentially impossible, even in the face of forgetfulness, life chaos, or occasional financial distress. Component 1 is automating the minimum payment for every credit card account. Every account, every month, automatically pays the minimum by your due date regardless of any other action or inaction on your part. This automation is the safety net that ensures you never miss a payment deadline, entirely never trigger a late fee, never lose the grace period through simple forgetfulness. Never damage your payment history through a busy week that pushed the credit card payment out of your mind. Setting up autopay for the minimum is a one-time action that takes about 5 minutes per account in your bank's online portal or within the card issuer's app, and it permanently eliminates the risk of missed payments due to inattention. Component 2 is manually paying your full statement balance every time the statement closes, not the minimum. The full statement balance. The statement closing date, not the due date, is when you want to make this payment, or at least know that you will make it before the due date arrives. The third category is any card that sits within an ecosystem you plan to continue using. If you are building a Chase Ultimate Rewards strategy and you have had the Chase Freedom Unlimited open for 4 years, closing it would not only reduce your available credit and lower your average account age, it would also remove a card that is actively earning points in your preferred rewards ecosystem and that pairs synergistically with your other Chase cards. The long-term rewards cost of losing that card may exceed the short-term benefit of simplification several times over. So when is canceling a credit card actually the right decision? Because there are legitimate situations where keeping a card open causes more harm than closing it would. The clearest case is a card with a high annual fee whose benefits you no longer use, and that cannot be downgraded to a no-fee product. If you are paying $250 per year for a premium card whose travel credits require a travel pattern you no longer follow, whose dining credits apply to restaurants you never visit, and whose reward structure no longer fits your spending, you are effectively paying $250 per year for nothing. In that case, the annual financial cost of keeping the card may genuinely exceed the credit score cost of closing it, especially if you have a strong enough credit profile that the utilization and history impacts would be manageable. Another legitimate closure scenario is a card that is actively enabling harmful financial behavior. If having a particular credit card with a high limit is contributing to spending patterns that are producing debt you cannot manage, the psychological and financial cost of keeping it open may be real and serious. In that case, the credit score impact of closure is an acceptable trade-off for the behavioral benefit of removing the tool that is causing the problem. Financial health and credit score optimization are both important, but they do not always point in the same direction, and in cases of genuine financial harm, health comes first. A third scenario where cancellation may be appropriate is a card with an annual fee on an account that is very new, less than a year old, that offered a welcome bonus, but whose ongoing value does not justify the fee, and where the account is young enough that closing it has relatively minimal impact on your average account age. If the account is 6 months old and it is not your only card or your highest limit card, the credit score damage from closing a 6-month-old account is meaningfully smaller than the damage from closing a 6-year-old account. Before you cancel any card for any reason, there are several alternatives that should be explored and exhausted before closure becomes the conclusion. The most powerful alternative is the product change, also called a downgrade. Most major credit card issuers allow you to convert a premium card with an annual fee into a no annual fee version of a card within the same product family. Chase allows you to convert a Sapphire Preferred into a Freedom Flex. American Express allows you to convert a Gold card into an Amex Everyday card. Capital One allows conversions within their card family. The product change eliminates the annual fee, preserves your credit limit, preserves your account age, preserves your credit history, and keeps the account active and contributing positively to your credit profile. It is almost always the superior alternative to cancellation for fee-justified closure decisions. The second alternative is the retention call. Before canceling any annual fee card, call the retention department and tell them you are considering closing the account because the annual fee no longer feels justified. The retention department is specifically staffed to prevent exactly this conversation from ending in cancellation, and they have tools available: statement credits, bonus points, temporary fee waivers that regular customer service representatives do not. A single retention call on a premium card has a meaningful probability of producing a retention offer worth several times the annual fee, which immediately changes the economics of the decision. You will never know what offer might be available unless you make the call, and the call costs you nothing but 10 minutes. The third alternative is simply keeping the card open with minimal usage. If a no annual fee card is sitting in your drawer unused and you are tempted to close it for simplicity, the better approach is to put one small recurring charge on it: a streaming subscription, a phone bill, a monthly utility. Set it to autopay and otherwise ignore it completely. The card stays active. The account ages. The available credit contributes to your utilization ratio. The simplicity you are seeking is largely achieved because the management required is a single automated payment that requires no ongoing attention. If you have already canceled a card and you are now dealing with the credit score consequences, here is the recovery plan. First, do not panic. The damage is real, but it is not permanent, and it is not catastrophic for most people with otherwise solid credit profiles. Second, focus immediately on reducing balances on your remaining cards to bring your utilization back down to where it was before the closure. If the utilization spike is the primary driver of your score drop, bringing utilization back below 10% on all remaining cards will recover a significant portion of the lost points within 1 to 2 billing cycles. Third, if the drop score has pushed you into a range that is affecting financial decisions you need to make in the near term, consider becoming an authorized user on a trusted person's well-managed account to add a high limit, long-standing account to your profile that improves your utilization and potentially your average account age simultaneously. Fourth, resist the temptation to open a new card immediately to replace the lost available credit. A new card application triggers a hard inquiry, the new account has zero age, and both of those factors work against your score in the short term. Wait at least 6 months before opening new credit, longer if your score is still recovering. The credit card you close today is not just a piece of plastic or a line item in a banking app. It is a contributor to a credit profile that took years to build and that will take years to fully rebuild if damaged significantly. The decision to close it deserves at least a few minutes of careful analysis of the specific impacts on your specific profile before you pick up the phone. The alternatives to cancellation are almost always available. The product change, the retention call, the minimal usage strategy, any of these is a better outcome than the closure for the vast majority of situations where people feel tempted to cancel. Your credit score is an asset. It took time to build, and it deserves to be protected with the same intentionality you would bring to any other asset in your financial life. Treat every credit account as a component of that asset and evaluate decisions about it accordingly. Subscribe to Klux One Finance if you have not already. Hit the bell notification so you catch every video we release. Share this with someone who is thinking about canceling a card right now. And I will see you in the next one.